Are we on the brink of a new era in commercial real estate, where artificial intelligence not only optimizes energy use, but also significantly reduces carbon emissions? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In a pivotal move that could redefine the landscape of commercial real estate, Train Technologies has acquired BrainBox AI. This acquisition positions Train as a leader in the $300 billion building systems market, focusing on AI-driven energy efficiency and carbon reduction. BrainBox AI's platform, already implemented in over 14,000 buildings worldwide, has demonstrated the ability to reduce energy consumption by 25% and cut emissions by 40%. This strategic acquisition highlights the growing importance of sustainability in commercial real estate and the potential for AI to transform traditional building systems. Train's acquisition is not just a simple addition to their portfolio, it's a strategic move to dominate the next phase of the smart building revolution. By incorporating BrainBox AI's deep learning algorithms into their Train autonomous control system, they are enhancing digital capabilities and accelerating the deployment of solutions that align with global net zero targets. This synergy is expected to offer seamless, end-to-end solutions for facility managers aiming to reduce operational costs and environmental footprints. The market disruption brought by AI as the new standard in building systems is profound. BrainBox AI's ARIA platform, known as the world's first virtual building engineer, enables real-time data visualization and autonomous decision-making, allowing facility managers to optimize energy use and predict maintenance needs. With commercial buildings accounting for 19% of U.S. carbon emissions, the demand for AI-driven solutions is growing, driven by regulatory pressures and corporate sustainability goals. Financially, Train's first quarter 2025 results showcase a company in strong health, with $4.69 billion in revenue and a robust balance sheet. Although the financial terms of the acquisition remain undisclosed, the strategic value of integrating AI into sustainability solutions is clear. As ESG criteria gain prominence, companies like Train that adopt AI for energy efficiency are likely to outperform their peers, making this an attractive investment for ESG-focused portfolios. In conclusion, Train's acquisition of BrainBox AI is a masterstroke in the race to decarbonize commercial real estate. By leveraging AI, the company is addressing a substantial market while aligning with global sustainability goals. As the world faces climate challenges, Train's strategic move positions it as a leader in a sector poised for exponential growth. This is not just a trend, it's the future of commercial real estate. Houston is experiencing a retail construction boom, ranking as the second most active market in the United States for new retail space development. According to a report by commercial real estate services provider Leasing Associates, Houston currently has nearly 3.9 million square feet of retail space under construction. To put that into perspective, this amount is equivalent to the space of 21 Walmart supercenters, each averaging 182,000 square feet. Only Dallas-Fort Worth surpasses Houston in retail construction activity. The Dallas-Fort Worth area leads over 60 U.S. retail markets with nearly 7.15 million square feet of retail space under construction. This volume represents 15% of all retail space being developed across the tracked U.S. markets by Lee and Associates. Not far behind Houston is Austin, which ranks third with more than 3.4 million square feet of retail space under development. The surge in retail construction across Texas is largely driven by population growth. The U.S. Census Bureau data highlights that Houston was the second fastest growing metropolitan area from 2023 to 2024. Meanwhile, Dallas-Fort Worth ranked as the third fastest growing metro, and Austin came in at number 13. This population influx is fueling the demand for more retail space to accommodate the growing number of residents in these vibrant Texas cities. Student housing is emerging as a significant opportunity in the commercial real estate market. With college students returning to campuses across the country, the demand for both on-campus and off-campus housing is on the rise. According to Jeff Brown, the founder and chief executive officer of T2 Capital Management, student housing is a favorite asset class for his company. However, he emphasizes the importance of evaluating each school individually before making investment decisions. A recent comparison from the Wall Street Journal highlights the disparity in student housing between smaller schools like Western Illinois, where dormitories have been razed to empty fields, and larger institutions such as the University of Illinois, which continue to thrive. This underscores the need for careful assessment of the risks and rewards associated with student housing investments. One crucial factor to consider is the mandate for first-year students to live on or around campus. Jeff Brown notes that understanding whether students have the option to live off campus is part of the extensive analysis required. His company has found success in off-campus student housing, especially in areas where transportation to campus is available, making it a viable investment option. Despite rising construction costs, the appeal of off-campus housing investments lies in acquiring properties in the secondary market that offer students more affordable alternatives. This approach has proven to be lucrative, as these properties provide lower-cost housing solutions. On-campus housing is seeing an increase in mixed-use development, with colleges aiming to create small communities that encourage students to spend more time and money near their dormitories. These developments often include retail elements such as pharmacies, restaurants, and entertainment venues, making them attractive options for investment. The rising cost of education also plays a critical role in the student housing market. With federal funding cuts and student debt forgiveness off the table, students are becoming more conscious of the return on investment in their education. This financial awareness impacts their housing choices, making affordability a key consideration for developers and investors. For commercial real estate mortgage brokers, it's essential to thoroughly research prospective schools, enrollment trends, and potential returns on investment before advising clients on student housing deals. Understanding these factors is crucial in assessing demand and ensuring a successful investment in this growing sector of commercial real estate. Commercial real estate lending has experienced a significant rebound in 2025, as indicated by a recent report from CBRE. The volume of internal United States commercial real estate loan closings increased by 45% between the second quarter of 2024 and the second quarter of 2025. This resurgence is largely attributed to the recovery of the commercial mortgage-backed securities market and a growing confidence in alternative credit options. James Millen, CBRE's president and co-head of capital markets for the U.S. and Canada, mentioned that the initial challenges in the second quarter were overcome once the Trump administration's tariffs were delayed, allowing capital flows and credit spreads to stabilize. He emphasized the resilience and stabilization of the capital markets, highlighting the strong investor interest in industrial and multifamily assets, especially those priced below replacement cost. Alternative lenders and commercial mortgage-backed securities have been the primary drivers of lending growth this year, while many banks remain cautious. Private credit lenders, including debt funds and mortgage real estate investment trusts, increased their share of loans brokered with CBRE from 32% in the second quarter of 2024 to 34% in the second quarter of 2025. Debt funds alone saw a 52% increase in lending volumes year over year. The commercial mortgage-backed securities sector, particularly active in New York City, saw its lending volumes with CBRE nearly triple, growing from 9% to 19% year over year. This surge in activity comes as banks and life insurance companies saw their non-agency share lending volumes decrease, although bank commercial real estate originations did grow by 17% over the last year, and life company lending increased by 2% in the first 2 quarters of the year. James Millen expects sustained momentum for CBRE as the capital markets adapt to evolving credit conditions. He believes that despite ongoing challenges, the robust pipelines and flexibility within capital markets position them for continued growth in transaction volumes across both sales and debt. This optimism reflects a broader trend of resilience and adaptation within the commercial real estate sector. North Texas is witnessing a surge in office leasing, with momentum building as companies secure new leases in Plano and Frisco. According to a report by Partners, although the Dallas-Fort Worth office market saw a 7% slowdown in leasing activity during the second quarter compared to the previous quarter, the activity was still up by 23% compared to the same period in 2024. 3 companies have recently signed leases at the Willow Bend Office Center in Plano, totaling 70,000 square feet, as reported by Newmark. This indicates a rising interest in the region's office spaces, despite previous slowdowns. The increase in leasing activity reflects a broader trend of companies seeking office spaces that align with their strategic growth plans and employee needs. The Dallas Business Journal highlights that this uptick in leasing activity is not isolated. The region is seeing renewed interest from companies looking to expand or relocate their headquarters, spurred by the area's robust economic conditions and strategic location. This trend is expected to continue as companies evaluate their office space needs in response to evolving work models. As we observe these developments in North Texas, it's essential to consider how similar trends might unfold in other regions, such as Kitchener-Waterloo, London, and Cambridge, Ontario. These areas, known for their strong technology sectors and educational institutions, may also experience increased demand for office spaces as businesses look to capitalize on local talent and innovation hubs. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.